you are a beginner trader, you have one job and only one job. It's not to make money. It's not to win trades. Your only responsibility is to learn. And that will be your only responsibility for most of your trading career, because you're not expected to understand everything immediately, and you should not try to force understanding before the foundation of market understanding is in place. So let's start with the basics and let's get into market structure. So foundations are the thing that we have to start with. Well, let's start with the foundation of market structure, because that is what I'm trying to teach here. Because if you don't know market structure properly, you don't know shit. So let's get the basics out of the way so we can get to the fun stuff, okay? So it's important to note that all the material in learning how to trade is cumulative, meaning that everything you learn at step one is going to feed into step two, but you can't learn step two unless you have step one figured out, because each concept depends on the previous one, and the understanding, the full breadth of knowledge comes from repetition and exposure over time, not from a single read through. So confusion right now is going to be normal and expected. So even if you are an expert trader who isn't profitable yet, which means you weren't an expert or even a veteran, you're still a beginner, you will benefit from this. Okay, so don't skip through. Repeat it over and over again, because repetition is the key to success. And you'll see even the most advanced people working on the fundamental basics of their craft. So the most basic concept in market structure is going to be the trend. All right, an uptrend and a downtrend, which are defined by very simple components that most traders are taught early on in your career, yet for some reason still don't understand. Now, an uptrend is defined, as you know, by a sequence of higher lows and higher highs, right? So a higher low form, which is right here, when large participants step into the market with buy orders preventing price from falling further. Now a higher high, which is going to be right here, forms when those participants take partial profits and introduce short-term selling, creating a pullback that allows them to reload at better prices. Okay, very, very simple stuff. All right, and so when this sequence repeats, guess what we have? The market, it is considered to be trending upwards. Market participants buy, they get to a good price, they made their profit, they cut some profits, creating a short-term imbalance in favor of the sellers. Price comes back down, and they really those buy positions because the market fundamentals support buying that asset until it doesn't support buying that asset anymore. Now, this is looking very, very, very clean. It looks very, very straightforward. However, the market does never produces a perfect trend every single time. So it's important to understand sometimes the market's going to look like this with your higher low there, higher low there. I'm just going to take my magnet off. Higher high there, higher high there, you know, even an internal higher high right there. And then we can actually zoom out a little bit and we can get another uptrend. Higher low, higher low, higher low. So the market is going to show you a trend in different ways. So it's important to understand that your rules need to be able to find your levels in different ways, or the same way in these different type of market characteristics, okay? Now, if we're gonna go to the reverse, we're gonna look at a downtrend, okay? So a downtrend follows the same logic, but just in reverse, right? It is identified by lower lows, okay, and lower highs. Now, a lower high forms when large participants enter with sell orders, as we know, as we just spoke about that, but for the buyers, stopping price from moving higher, and a lower low forms when they take partial profits and introduce short-term buying, creating a temporary pullback before continuing lower. Now, price does not move in a uniform pattern, and no two trends will ever look the same, okay? So that's why we learn like this, but we understand that the market isn't always going to produce trends that look freaking perfect like this. Now, it is actually important for you to understand where the market participants are in there. So when you see a lower low form, well, that is not a buy opportunity. That's an opportunity for the buyers who think it's buying to get liquidated by the institutional sellers who are indefinitely selling there. Now, even though this visual difference differs, the underlying structure is consistent. And if you know what you're looking for, you will always find the same components repeated in different shapes and proportions. And this is why trends can be identified across all markets and all time frames. And as this sequence repeats, as usual, the market is considered to be trending downwards. So you have your sequence of lower lows and lower highs. Okay, like I said, basic stuff. Now, if we're going to go look at the market, see if we can find different market trends to the downside, we look here. Well, we have our lower highs, lower highs, lower highs, lower lows, lower lows, lower lows. But if we want to go back and find a downtrend as well, you're going to see it looks quite different than the one we just went through there. There we go. So we have our lower highs, lower lows, lower lows. Now I know I'm breezing through this, but this is basic stuff that you should have learned on your first day of Forex school. So like we said before, price does not move in a uniform pattern, and two trends will ever look exactly the same. However, even though the visual appearance differs, the underlying structure is always going to be consistent. If you know what you are looking for, you will always find the same components repeated in different shapes and proportions, this is why trends can be identified across all markets and time frames. Now, these higher highs, higher lows, and lower lows form the foundation of nearly every trading strategy taught to retail traders. Whether the strategy is a break and retest, rejection from levels, trend continuation, or reversals, it almost always relies on these exact reference points. Now, traders are trained to mark highs and lows, wait for breaks, and anticipate reactions around those levels. This is considered standard technical analysis, and it is treated as universal knowledge. But this creates a problem, because when everyone uses the same reference points, behavior becomes predictable. Retail traders enter the same areas, place stops at similar locations, and target similar exits. The market does not move randomly against them. It moves through areas where liquidity exists. And so when large participants need to enter or exit positions, they require opposing orders, and predictable retail behavior provides those orders. And so retail traders lose not because the concept of highs and lows is wrong, but because they treat those points as the primary decision-making reference. And they build their entire strategy around reacting to the most obvious structural markers on the chart. And this makes their behavior easy to anticipate. So when too many traders are positioned the same way, price will move through those levels to access liquidity before continuing. And this is why simply knowing where highs and lows are does not provide an edge. These points describe structure, but they do not explain intent. They tell you what happened, but not why price moved the way it did. And without understanding where liquidity sits and how it is used, traders end up reacting to price instead of understanding the conditions that drive it. And so the question then becomes how to view the market differently. If highs and lows are not enough on their own, what additional context is missing? And this is where the concept of liquidity becomes necessary, because liquidity explains why price moves through obvious levels instead of respecting them. Okay? It explains why breakouts fail, why stops are hit before reversals, and why predictable strategies struggle over time. And so this is where we introduce what I call the containment theory, and it builds on this understanding. But containment cannot be understood without first understanding liquidity. And what liquidity is it provides the reason price behaves the way it does inside trends. Containment provides a different way to organize that behavior so that it is no longer viewed through the same reference points that most retail traders rely on. And retail traders lose because their analysis is incomplete, not because they are incapable. And once you understand how structure, liquidity, and containment work together, the market stops looking random and starts looking organized. But that understanding comes in stages, and this stage is about learning how structure is commonly taught and why that alone is simply not enough.